Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, December 2nd, 2022. It's 9:55 a.m. Eastern Time as I'm starting the video, and I'm going to go over some levels. I left a couple things out in yesterday's video that I intended to cover, one of those being the VIX. I'm going to do a quick update here on the markets. Before I get into the more of the swing trade levels, bigger things to watch for the bigger picture, just a quick update on day trading, active trading. I've told you I've been in that mode lately, and we'll remain there. We're going to see this is what you see, end of the year, these kind of crazy rips and dips. We are definitely in a psychotic market. This was on just a whisper, the sort of the implication or indication that Powell's only going to raise 50 basis points instead of 75 at the next meeting. I already assumed that was the general consensus. It was priced in the futures from most pundits I talked to, as well as myself. You have four back-to-back three-quarter point rate hikes, one of the strongest rate hiking campaigns in decades. We knew the rate of ascent was going to slow, and market took it as a Powell said he's going to start cutting rates, which it's not. So a bit of an overreaction, and then of course you had a equal, and that's what I've talked about lately. You almost can just trade these mean reversion trades in this time of year. Market goes up 2-3%, pops up, then you're going to have a fade. Market drops 2-3%, you're going to have a bounce back, and you can see so far. So the Powell pop, which was also technically induced, you had the downtrend line right here, and then you popped it right there. That has been cut in half right now, faded. So as far as trades go, let me just show you active trading. Yesterday, on the morning, I got out this trade to you here, pullback trade for about 0.5% off the divergent high. We hit it, and I always say, and I repeat myself often, but it's important to reiterate that I'm showing you charts that these are the charts I'm trading off of, and I have actual support levels. And on short trades, you always want to cover a little shy the actual support level, because traders like myself will often want to cover early. The buyers may step in early, or the shorts may cover early, and that's what I do. It's just not worth trying to eke out that last fraction of 1% of a trade, especially in active trading. Active trading is day trading, short-term swing trading. You're going to make, like I said, that trade yesterday was about 1.5%. What are you going to make an extra, 7 basis points to try to milk out that last bit? So, it was a point which I did cover, reverse, bounce, and then I did the video. I said we'll probably get one more leg down, even a bigger leg down. I think that level would be taken out. And so I fired that post off as quick as I could to you this morning, saying that's an objective place. That's where I covered for a bounce trade up to here. Once again, you don't, if you reverse there and went long, you don't wait for 11,928. You cover a little, you sell your long, which I did a little shy there, and then of course expecting a reaction there, game a pullback, and then I put an updated chart in the comment section. As soon as I did this, I reversed back to short for a pullback here. You can see that level is already on the chart. And that's all I'm looking for now, and I'm going to game a little bounce off here, and then, or at least attempt to, and then get out. But I think the risk reward is starting to skew from the bullish or upside to the downside on the bigger picture. But this is again active trading. If it's not your thing, don't try it. But what I do with active trading is I tend to take, and especially day trading, much larger position sizes than swing trading, because you don't have overnight risk. You're only shooting for 2-3%, sometimes 0.5% trades, and therefore you can take a larger position size. Me personally, sometimes my stops are 1-to-1. I'll give myself because the probability of success on these trades, when volatility is spiking up, you can sit here and just game these little bounces off support and resistance, and they don't have to be much. So again, it's worth it if you put enough in. You're trading leverage contracts like the futures or SQQQ, and you have enough. A 0.5% gain can certainly give you a few bucks in your pocket. But if it's not your cup of tea, start practicing and start small and work on daily time frames and 60-minute. I'm going to get to that in a second, talk about swing trading. But again, that's just been this market's been conducive to active trading, and this is really how I've gamed it the last few days. And I think going forward, when these opportunities present, I told you I'm going to show you more of these short-term trading opportunities, as long as the opportunities, as long as that's the mode I'm in. That's what this site's all about. It's sort of like a journal blog, showing you what I'm doing, what I'm seeing, why I'm doing it, and then I always say, pass on trades that do not align or mesh with your trading style, your risk tolerance, or your views on that particular security. I tend to be very contrarian. That's obvious in the comments on the site, and then, the trades that I can tell most take. Most people don't want to short when the market's going up, and it's been going up for a few weeks, and most don't want to buy when things have been going down, 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 and that's I don't buy something for the sake of it going down. There are certain things that I look for, those pivots, those reversals. All right, let me show you some more significant levels, and I will wrap this video up. I did not intend this to be a long one, nor will it be. 60-minute charts. This is the big trend line. I got this one also out in the comment section below the post this morning. This is the NQ Nasdaq 100 60-minute chart. Again, on this morning's post, when we had that big drop on the employment numbers, the hot employment data, that was an opportunity to quickly jump on that, and we actually stayed down there from the time I got that post out. You had plenty of time, probably 15 minutes or more before the future started moving up, and they held that support perfectly, the one I just showed you. But here's what we need to watch. This is bigger picture stuff. So you had a trend line here, a downtrend line that was taken out, goes even to the left of the chart, but now we've undercut that. We're pretty much right back on it right now. We put in a small divergent high here on the 60-minute chart, which was also the catalyst for this drop. And if you look at it this way, it looks like a little head and shoulders as well when you zoom in. You have like a mini head and shoulders here with a left shoulder, head, right shoulder right there, second right shoulder. You had really what they call complex head and shoulder. So it was like a mini pattern. It played out. There's a measured target, would be the distance from the top of the head to the neckline, and it certainly played out. But what I wanted to show you is, very near term, other what I talked about on the short-term charts. This is a level to watch right here. I think this is, if you want to watch, and that's what the point of this video. I'm going to give you really just a handful of levels to watch. NQ Nasdaq 100, that comes off the lows in early November right here. So that's a pretty clean trend line. We have at least 3 distinct reaction points there, and I think that will be technically significant. I don't think we're going to break it today, tomorrow, next week, or this week. We've got the Fed coming up. So market's probably going to grind around. Whipsaws are pretty likely. There was some support there that was broken. I need to add a line. I'm sorry, when I look at these charts, if I miss something, I always add it up or add it in. And that's because we had a reaction right here, one there, and right here. So now that's resistance. So any bounce back to that level would provide an objective short entry, and of course a break of this trend line. I'm suspecting it may not come till after the Fed, but who knows? You never know. So take it on faith. There's the last comparable. We had a trend line break right there. Anywho, just something to watch. And look, if we push up, and I'm very open to this, I'm 6 to 1/2 dozen of the other, we may get another thrust up. Remember, yesterday, as I pointed out, we hit those major trend lines. So that was, as I said, there was 2 objective entries there. There was an objective entry for a swing or trend trader to start layering in, if you haven't already, or added to if you're already doing it, trend or swing short positions, as well as for an active trader to simply game the initial pullback. Every time you hit a key resistance level, if we haven't hit it in a while, let me show you what I'm talking about, because I can see it in my mind's eye. But mainly, let's look at the S&P 500. So that's it. So this is our bear market downtrend line. That's on what it looks like on a 60-minute chart. There it is on the daily chart. I give you a clean version right here. So what happens is the initial tag, once it's been established and you rally up to that, a lot of eyes are going to see that trend line. I don't know how you can miss it. It's pretty obvious, and you have the same thing on the NASDAQ. You have it on the small caps. You have those downtrend lines. So at the very minimum, you're usually going to get at least a tradable pullback, even if the trend line is going to get taken out. So that's what I meant by active traders. shorting there yesterday, and then you could have covered that pullback in the pre-market session. And if you did, it was good for, that's where we were yesterday when we hit it at the highs. It was good for about a 2% pullback trade. Okay, so levels to watch, going back to where we were. Let me go back to the futures. NQ, there's your trend line. That's it. So I would certainly watch this one. And then when you go to ES, I'll get to the ETFs in a second. I start with the futures. Futures, not only they my preferred trading proxies, but they also have more reaction points because they trade around the clock. So you're going to see trend lines and horizontal price resistance and support levels that you're not going to pick up on QQQ and SPY because you only have a fraction of the candles. All right, so there's just a beautiful uptrend line. I just zoomed down. That's a 3-month chart, hourly candles, and you can see we also have, see this negative divergence here? These are my patterns. These are my favorite patterns. No guarantee they'll play out, but they often do. And this is the big part of my swing trading. So I see a bearish rising wedge pattern. I see an uptrend line off the on ES. It's the October lows right there, about mid-October, right about the 15th or so. And so you want to see that and NQ both get taken out. You see those trend lines get taken out with conviction. That means an impulsive drop, or let's say a solid, at least a 60-minute candle close, even a daily close, all the better. In other words, the farther you get away from it, the less chance it's going to be to be a whipsaw. But so you're going to watch this one. Let me make it a little thicker here. Change trend line thickness. There it is. So that's a big one. And let me see. I might have it on RTY. Nope, I didn't want to do that. Let me pull this. I already have a chart here. RTY. 3 months. Let's see how that looks. Let's see if we have a comparable trend line off the lows there. Not as clean, but again, this is the small caps. They kind of do their own thing to an extent at times, but the large caps are the market. If the large caps break down, that's Apple, Amazon, Microsoft. They're going to bring the small caps down with them, kicking and screaming, even if it's not right away. So you can see a comparable trend line with a little bit of a whipsaw there. And again, I don't think these lines are going to go. Right now, I'm at least at this very moment favoring some more alongside bias. I'll talk real quick. Fundamentally, like I said, this is a psychotic market. Jobs numbers came out really strong today, and so the market's thinking, okay, that's going to make Powell, be more hawkish, right? Well, you can spin it any way you want. That's what this market's trying to figure out. Fundamentally, it's actually a great sign. We're raising rates, and everyone was worried about this bad jobs number and it's stronger than expected. It's showing you that the economy is still very, at least that component of it, very resilient. And if you're, fundamental analysis or economics, I should say, consumer spending accounts for 2/3 of GDP, gross domestic product. So when the consumer's strong and they have jobs, they're strong. Anyway, so you can make the case that if you want to be bullish, saying, hey, okay, rates have been going up, and that should be bearish for the market, but that's usually only bearish because when rates go up, it retards or slows the economic cycle. Slows economic growth down. But in a perfect world, in a Goldilocks world, you can have rates going up, and if that's not happening, so. Anyway, I can sit here all day long, and that's what they do mostly on the financial media. You watch on Bloomberg and CNBC. That's all they're talking about and trying to figure out where the market's going based on this, that, and the other. The charts are so much easier and they're so much more accurate. They will price in what is likely going to happen and what is happening. So it's fun to kick around the fundamentals, and I'll give you my 2 cents at times, but at the end of the day, the charts have to be your guide. So like I said, you can take it, and people do. That's confirmation bias. People take news, they can spin bad news to be good to fit their narrative, or if they're bullish, or if they're bearish, they can spin good news to be bad, and they do. And just be careful. That confirmation bias can really, really hurt you. All right, the other things I wanted to show you besides these trend lines here are the VIX, the Volatility Index. This is the one I meant to cover yesterday in the video. if you recall, a few weeks back, no, actually, it was all the way back here, so it would have been, it was about this time. Yeah, it was around the beginning of the month, a few weeks back. Yeah, that's right. I said, watch this trend line here. And I think I might have showed it to you on a 60-minute chart. Can't remember if it was a 60, and we had a little pop right after that, but it was just a spike that was immediately reversed. I said, this is the trend line. When we break this trend line, that's your next moment to get, kind of, well, I will say aggressively short. In other words, if you're scaling in right now, you're looking for the next turn. This is it. Now the VIX is set up. And I made it pretty clear yesterday. I think it's time to start getting back into the swing short positions. It wasn't, I don't think I was wishy-washy about that at all. And now you can see we have positive divergence. The VIX does have, in my opinion, predictive value. It's almost a coincident indicator. It's going to move inversely to the stock market, but there's been many, many times in the past that I like to use the VIX to align my analysis on the stock market or help to confirm it, just like I do with the US dollar and the euro for gold and silver, right? I look first and foremost, if I'm going to trade gold and silver, I want to see their charts bullish or bearish to justify a long or short position. But secondly, I like to look at the US dollar and the euro because gold and silver trade inversely to those. They definitely impact it. So all the better when at the same time I can make a bullish case to buy gold or buy silver or both. They tend to move together. I should be able to make a case to be bearish or short the dollar and bullish or long the euro. And that's kind of the analysis I gave you yesterday. And here you can see the VIX has positive divergence on the 60-minute chart. So, like I said, just bouncing the, trades around. In fact, I may pause the video here. Long at the moment, and had multiple trades today. 1, 2, 3. Yeah, I'm gonna let's see here. I've got an RTY, a sell order right here. I'm just talking to myself. Let me pause the video. Oh, there it is. Okay, that one should have filled. Okay, yes it did. All right, and that's it. So just one more reversal. Already reversed. A little shy, but now we're actually a little closer. All the better. And then maybe that'll be it for now. Let me get back to where I was on the VIX. My apologies there. I just had to make sure I had all my orders in place. So here's what I did. Yep, took a shot here, right here. And this is just added this nice resistance level there. I was looking. That's that neckline I showed you earlier. And so I've got a second lot. Actually, it's 2/3 the amount, and then that's how I'm going to trade. So I'll be full short there. And then I will stop out above this level. I'm giving this one some room. I think we'll fade this back down. There's a very good chance you're going to have downtrend line resistance right here. There's a confluence resistance. So this is what we're most likely looking at. And again, just active trading, bounce around, little short-term pullbacks, go long, short, long, short. Let me get back to what I was showing you on the VIX. Yeah, sorry, I paused it again. So revamped. But right there, see that reaction low. So I just added a lot here and then have readjusted that. So that'll be, if that gets hit, that'll be the final lot right there for just one more pullback trade. Just bouncing this thing around. Sorry about that. It's hard to concentrate when the NQs are whipping around like this. That's when you can make some money actively trading. But alrighty, last one, and we'll wrap this up. So anyways, there it is, divergent low, beautiful downtrend line. You see even better on the daily chart, or as well, it's the same downtrend line. Lots of reactions, and these are levels. I've had this level here forever. This one was created back in 2018. You can see that. And 1983, it's been support for a while. It really defines these ranges. There's it's just a level I see a lot of reactions. It was big support right here. It was a gap support zone, and we did violate it there, went under, but it's been acting as support more recently, and that's the important thing. When I look at a line, you always give a higher weighting to the most recent reaction. So there you have it. You have the VIX at support. If it goes lower, which if we get another thrust up in the market, it will. Likely. Sometimes you'll see the VIX starting to rise even when the market's rising, and that's a little rut row moment for the bulls. But look, you have nice trend line as well. So in the VIX, by the way, this is a trade. There are VIX tracking ETNs. Be careful with those. So some of them in the past have blown up. But you can trade VIX futures. You can trade options on the VIX futures, or you can just use this to align with the indexes. It's really all the same. The VIX is just like a leveraged play on the indexes because it moves up in percentage terms a lot more. Anyway, that's it. Oh, and remember I've been going over those pending PPO crossovers. Same thing here in reverse. That's we don't have it yet. I'll throw up the histogram and then you'll see. But you can see the hill, right? And that's what I was talking about on the indexes, but in reverse. So we haven't crossed, just like the indexes haven't fired off yet. There was the last bullish crossover. So you decide, did you want to be long or short that point? And you had almost an identical setup. You had a downtrend line. You got the trend change, that signal there on the PPO. Boom. That was a move. Even if well, I'll just go from where a crossover happened right there. Just this ballpark, 70% rally. And again, that's because of VIX moves. And see these downtrend lines? It's like an EKG, but with predictability. Well, a normal EKG is the blips, but it's more of like an erratic EKG. Somebody's got heart problems, but you can predict when you're going to get the next spike up. You get these blips, blip, blip, beep, 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 and that's it. All right, so that's what we're looking for. Now we can go lower, we're not. Either way, I think I had an alert set here. If I'm not, then I'll make sure I do right now. Look for that bullish crossover on the PPO, and remember on the indexes, the same thing. We were close the other day when I pointed out last time. I pointed out back here. We still don't have the crossover, so it's close but no cigar yet. But you're at downtrend line resistance, and again, I've talked about this. There's no guarantees, but when these things start rolling over, it's a momentum indicator. When the hill peaks out and you start getting lower peaks, it shows you momentum is waning, and ultimately a bearish crossover is likely. And then I've already covered this. You know what happens after you get the bearish crossovers, right? All right, that's it. I don't think there's much more to add to it, and I'm beating a dead horse if I continue to show you that. So here's the uptrend line. I just want to do this for you. Draw that trend line. That's the same mid-October, October 15th. The big, that was the big Powell day. That was that big reversal, the bullish engulfing candle, October 13th. There's your uptrend line. So I'm going to tweak it to tighten it up here, catch those lows, set an alert there. This is how it works. There are no guarantees in trading, but it's all about putting the odds in your favor. So if I start getting alerts going off like popcorn, I see the NQs break the trend line, ES and SPY. You can't draw as clean a one here on QQQ, so I'm not going to force it. IWM, I already had one there. There it is. So, and I think I have an alert, and if not, I'm going to add an alert, and that's it. And of course, same thing. This one you already had the bearish PPO crossover. Could be a whipsaw, if we cross back green. But again, the small caps I don't put a big weighting on. It's these big caps. This is what's going to determine the next trend of the market. All right, guys, I'm going to wrap it up here. I told you it'd be a short video. We're 23 minutes. It was about as short as it gets for my videos. So one day my goal is to get them down to 10, 12 minutes. But, it's going to lack additional tidbits that I like to cover. It's all the devils are in the details in trading. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.